Now you can learn how to invest wisely. Hello and welcome to our video. Today, we will be summarizing The Intelligent Investor by Benjamin Graham. By the end of this short book summary, you will not only understand the big ideas and key takeaways from the book, but you will also be able to discuss and implement them as well. So be sure to watch until the end. But first, make sure to subscribe and hit the bell icon if you want to receive more money-making tips and to learn from more of the world's greatest books on personal finance, entrepreneurship, and mindset in a fraction of the time. Also, make sure to comment "I subscribe" below so that we can thank you. Benjamin Graham is known as the father of value investing. This book is a masterpiece on investing. The Intelligent Investor is all about investment in the stock market. Graham breaks down the science of investing in a stock. The book assures you learn the right technique to invest, minimize the risk, and profit from your investment. If you are into investment in stocks, you might want to take notes as we break down the key lessons from this book. Key lesson number 1: investment versus speculation. Graham suggests that you need to separate investment from speculation. The speculation involves day trading in the market, buying stocks with an expected increase in earnings, or long-term, selectively with an emphasis on past growth, assuming it will continue. Only 10% of your investment funds should be allocated to speculation. Key lesson number 2: profit to earnings ratio. Graham talks about the PE ratio, or profit to earnings ratio, as a guide to value a stock. A profit to earnings ratio is a simple tool for measuring the market's temperature. If a company earns $1 per share and its stock is $9 per share, the price to earnings ratio is 9. However, if the stock is worth $70, the price to earnings ratio is 70. In general, price to earning 10 is very low and inexpensive, while price to earning above 20 is expensive. Key lesson number 3: value investing. A term used by Graham means intelligent investing. According to Graham, value investing is based on 3 principles. Before investing, a wise investor considers a company's long-term evolution and management principles. They will always diversify their investment to protect themselves from losses. Intelligent investors seek safe and consistent returns rather than high profits. Key lesson number 4: Mr. Market is not trustworthy. Graham's most famous analogy is Mr. Market, in which he depicts the entire stock market as a single individual. What would you do if Mr. Market showed up on your doorstep every day, quoting you different prices for various stocks? You'd be better off ignoring him completely, according to Benjamin Graham. The prices he'd tell you seemed suspiciously low at times and astronomically high at others. That's because Mr. Market isn't very bright, is completely unpredictable, and suffers from severe mood swings. You might be wondering about who to trust then. Graham suggests you should rely on your own research and ignore the market trends. Key lesson number 5: formula investing. You must have heard of formula cars, but not formula investing. It is known as dollar cost averaging. This can be defined as setting a fixed budget for investment every month or quarterly. Then you invest that money into stocks you own or picked, no matter the price. This is a bit emotionally draining because you have to set aside the same amount every month. You will invest the same amount each time, no matter if the stocks are cheap or expensive. However, once you get over it, it's a great way to protect yourself from losses that could occur if you invest a large sum right before a crash. Key lesson number 6: are you a defensive investor or an enterprising investor? The defensive investor is unwilling to invest the necessary time and effort. Rather than taking an active approach, the investor prefers a portfolio that requires little effort, research, and monitoring. Investors will not expand their potential investing universe beyond stable, conservative choices. The enterprising investor has the time and experience or appropriate guidance in investing to broaden their universe of possible opportunities beyond conservative investments. It is an active strategy that necessitates constant attention and monitoring. The primary distinction between defensive and enterprising investors is the willingness of the investor to make the necessary effort to invest more aggressively. The astute investor must have the training and judgment or guidance to measure and maintain a margin of safety standard. You should be a defensive investor if you are unwilling to put forth the effort. That's it for our book summary on The Intelligent Investor by Benjamin Graham. We hope you found it both informative and entertaining. If you did, hit that like button as it helps the channel out. If you want to learn more, you should buy The Intelligent Investor by Benjamin Graham. You can pick it up with the affiliate links below. We will return with more book summaries and money-making tips soon. In the meantime, please like and subscribe to our channel. Remember to click the bell icon to be notified when a new video is added. Also, let us know in the comments if there's a specific book you want us to summarize next. And until next time, we hope your personal success surpasses your dreams. Goodbye.